Welcome back to ReadSmart, where we decode the world's most powerful ideas so you can build the wealth and life you deserve. Tonight, I'm giving you something extraordinary. Imagine spending nearly 5 decades on Wall Street, watching every crisis, every panic, every boom, and every collapse, and discovering that the secret to financial success has nothing to do with genius, luck, or secret formulas. What an extraordinary journey we embark upon today, delving into the very bedrock of financial triumph, guided by a man who has navigated the tumultuous seas of Wall Street for nearly 5 decades. Since 1976, beginning perhaps somewhat dramatically in that world's ugliest brown suit, he has sought to decipher the fundamental truth of capital. Today, presiding over BlackRock, an entity managing upwards of $11 trillion, a figure exceeding the GDP of most nations, he reveals that the chasm between the successful and the unsuccessful investor is not bridged by secret formulas, but by 5 simple, timeless rules. These are not mere academic concepts. These are battle-tested principles that survived 1987, the dot-com bubble, 9/11s, the 2008 crisis, and the pandemic principles rooted in human nature and the immutable realities of capital markets. Let us immediately commence with the very cornerstone of this philosophy, the rule most frequently and tragically violated. Golden rule number 1. Think in decades, not days. It sounds deceptively simple. This notion of long-term thinking, yet anxiety grips the leaders and investors of the world today, worried about inflation, interest rates, and geopolitical turmoil. But history offers a profound rebuttal to this short-term panic. For 423 years, since the Amsterdam Stock Exchange opened its doors in 1602, capital markets have stood as the single greatest wealth-building machine in human history, persevering through wars, famines, pandemics, and depressions. Consider this devastating truth. If one had invested in the U.S. stock market in 1926 and simply held that investment until 2023 through the Great Depression. Yet, what is the default behavior? Investors scrutinize their portfolios daily, weekly, or monthly. When the inevitable downturn arrives, they panic, they sell, they retreat to cash, locking in their losses. In 2008, markets plunged 50%. Those who sold missed the recovery that saw the S&P 500 hit new highs just 5 years later, by 2013. Similarly, in the chaos of 2020, people jettisoned assets during a 34% drop, only for markets to be back at all-time highs 5 months later. This is why thinking in decades is essential. It transforms short-term volatility into mere noise, irrelevant distraction. To practically implement this wisdom, one must first impose discipline. Limit checking your portfolio, perhaps quarterly, certainly not daily, as frequent viewing of red numbers generates pain that compels destructive action. Second, develop an investment plan and adhere to the original thesis. Unless the fundamental reason for buying a stock changes, patience is the ultimate required virtue. Third, embrace the power of automation through dollar-cost averaging, forcing consistent investment regardless of market mood and stripping emotion from the equation. Remember, especially for younger generations, time is your greatest asset. Compounding interest is your secret weapon, effective only when you commit to the long term. While the short-term market path is fundamentally unknowable, the long-term growth trajectory is certain. Golden rule number 2. Ownership is everything. The stark reality is that ownership is the singular engine of wealth creation, the mechanism that grants you a vested stake in growth. We are witnessing the rise of twin inverted economies, one where wealth perpetually compounds, and another where hardship relentlessly builds. The core difference? Ownership. The affluent economy owns assets, stocks, real estate, businesses, infrastructure. The lagging economy often owns nothing. They rent, work for wages, and hold stagnant savings accounts, merely watching growth occur for others. Capital markets. Revolutionary since 1602 when they allowed ordinary citizens, maids, and artisans to own shares of the Dutch East India Company, exist explicitly to democratize this ownership. If one desires genuine wealth, one must own assets that grow in value and participate in economic expansion, not just cash or savings accounts. The most accessible asset is stocks, equating to part ownership of a business that, if successful, dramatically increases your stake's value. While phenomenal growth stories like Amazon or Google illustrate the potential of ownership stakes, most individuals should strategically own broad index funds. thereby acquiring a piece of the entire economy. BlackRock championed this path through low-cost, diversified index investing, believing everyone should have access to ownership. However, a critical evolution is underway. The future of wealth creation is increasingly shifting towards private assets, private infrastructure, private credit, private equity, and real estate. Institutions already allocate 20% to 30% of their portfolios to these assets, consistently outperforming standard
401k
by 0.5% annually, a margin that, over 30 years, defines the difference between financial security and struggle. The mission now is to democratize this elite access, allowing everyday investors to own pieces of data centers, power grids, and ports, the very infrastructure powering civilization. This is economic democracy, and it guarantees that those who own assets 20 or 30 years from now will be wealthy, a guarantee based on 4 centuries of capital market history. Golden rule number 3, diversification is protection. Let us be unequivocal. Diversification is not merely owning a collection of random items or following internet tips. True diversification is a strategic, intentional structure, ensuring that when one segment of the portfolio falters, another thrives. For decades, the sacred text of investing was the 60-40 portfolio, 60% stocks, 40% bonds, functioning perfectly as assets were negatively correlated. But the world has changed. In 2022, both stocks and bonds suffered simultaneous declines, a catastrophic failure of the 60-40 model, driven by surging inflation and rising interest rates. A new paradigm is necessary. The 50-30-20 portfolio, 50% stocks, 30% bonds, and 20% dedicated to private assets, infrastructure, real estate, private credit. These private assets are essential because they maintain a low correlation to public markets. When the stock market collapses, toll roads continue collecting revenue and power grids continue operating, providing independent stability. Diversification must be approached across 5 crucial dimensions. 1. Asset classes, spreading risk across stocks, bonds, real estate, infrastructure, and commodities to smooth out overall returns. 2. Geography, investing internationally in Europe, Asia, and emerging markets to capture global growth and provide protection when one region stumbles. 3. Sectors. Within equities, owning diverse industries, tech, healthcare, financials, energy, to be positioned correctly across different economic cycles. 4. Time horizons. Balancing liquid short-term investments, cash, money market funds for immediate needs with long-term assets, stocks, infrastructure for multi-decade wealth building. 5. Active and passive. Relying on low-cost index funds for the core, but using selective active management in less efficient markets like emerging markets or private assets where skill can genuinely outperform. Understand that diversification is not a promise of safety. Your portfolio will still decline in bear markets. However, it minimizes volatility and, crucially, protects you from catastrophic loss. If the dot-com bubble burst caught you holding only tech stocks in 2000, you lost 80%. A diversified portfolio would have mitigated that loss significantly. Diversification is the armor that protects you from your own inevitable mistakes and concentrated convictions. Build your foundational core around broad diversification, then, if you must, allocate only 5 or 10% to those high-conviction, concentrated bets. Golden rule number 4. Costs matter more than you think. This rule may lack glamour. No one becomes passionate about expense ratios, but its financial impact is seismic. Let the cold mathematics speak the truth. A $100,000 investment held for 30 years earning 7% annually. The tragedy is that most people remain willfully ignorant of the fees they incur. They fail to examine the fine print of their 401k or IRA, often paying egregious expense ratios exceeding 2%. BlackRock has been engaged in a decades-long mission to crush these costs, launching ETFs that drove expense ratios down from 1 to 3% to as low as 0.03%, 3 basis points. This minimal cost difference compounds into astronomical wealth creation. Furthermore, while skilled active managers do exist in specialized areas like private credit or emerging markets, the vast reality is that the overwhelming majority of active managers, over 80% across a 10-year span, and over 90% across 20 years, fail to beat their benchmarks after fees are accounted for. Paying higher fees for inferior returns is illogical. This underscores why index funds remain the superior core investment. This cost consciousness must also extend to trading costs. Frequent trading, attempting to time the market and chasing the hot stock, actively destroys returns through commissions, spreads, and taxes. Studies show frequent retail traders underperform buy-and-hold investors by roughly 3% per year. The mandate is clear: minimize costs everywhere, select low-cost index funds for your core, and let compounding, powered by patience, perform its magic. Golden rule number 5. Stay humble and keep learning. This final golden rule is the necessary mindset that underpins and activates all the others. Even after decades leading a firm that manages trillions, the speaker still dedicates an hour, sometimes an hour and a half, every single day to studying markets and the world. Why? Because the world is in constant flux. Markets evolve, technologies emerge, and risks appear. Arrogance, the belief that one has figured it all out, leads to being blindsided and crushed. We recall the investors of the 1990s who, successful in manufacturing and retail, dismissed the internet as a fad, losing billions because they lacked the humility and curiosity to learn about the new technology. The speaker himself admitted initial skepticism regarding Bitcoin and cryptocurrency, viewing it initially as a vehicle for illicit activity. But curiosity prevailed. By studying the underlying blockchain and noting institutional interest, he adapted, and BlackRock successfully launched the iShares Bitcoin Trust. Humility and curiosity are investment superpowers because they enable adaptation, allow for the recognition of wrong assumptions, and facilitate course correction before it is too late. To foster this critical mindset, 1. Read constantly. Engage with market reports, academic papers, and economic data to understand the forces shaping the future. 2. Listen to disagreement. Actively seek out smart individuals who hold opposing views to challenge and broaden your perspective, thus avoiding the echo chamber. 3. Admit mistakes. This is the most difficult step, yet without acknowledging error, learning cannot occur and mistakes will be endlessly repeated. 4. Stay curious about technology. Commit to understanding transformative forces like artificial intelligence, blockchain, and biotechnology, as they are rapidly reshaping the global economy and creating immense opportunities. 5. Acknowledge uncertainty. Accept that no one can predict the precise path, timing, or exact winners and losers of the future. Humility means being flexible and prepared for multiple outcomes. These 5 golden rules: think in decades, secure ownership, demand diversification, minimize costs, and remain humble are not just tactics. They constitute a philosophy. Investing is not about quick riches or timing crashes, but about the disciplined, systematic construction of wealth over time. It is fundamentally an act of participation in human progress, funding the innovation and infrastructure that powers civilization, and in return, gaining a stake in that growth for yourself and your family. Trust the process, commit to the principles, and watch your wealth grow. If these 5 rules change the way you see investing even a little, then do yourself a favor. Don't just listen. Start applying. Think in decades. Own assets. Diversify intelligently. Cut your costs. Stay humble. This is the blueprint that separates financial security from lifelong struggle. If you found value today, tap like, subscribe, and share this with someone who needs a real financial wake-up call. If tonight's breakdown gives you the clarity you've been missing, like this video, subscribe to ReadSmart. Turn on notifications because the next episodes will break down the money frameworks used by the world's greatest investors, thinkers, and entrepreneurs. Now I want to hear from you. Which of the 5 golden rules hits you hardest? And which rule have you been ignoring the most? Type it in the comments. I read everyone. This is ReadSmart, where knowledge compounds faster than money. Let's begin.